Hi, I'm Ryan Castillo, a partner in Mayer Brown's Capital Markets Group based in New York. Today, we'll talk about the SEC's recent amendments to Regulation M, adopted last June 7, 2023. These final rules remove references to credit ratings from Regulation M, replace them with alternative measures of creditworthiness, and impose related record-keeping obligations on broker-dealers. By way of background, in the aftermath of the 2008 financial crisis, Congress enacted the Dodd-Frank Act and directed the SEC to review its rules and remove references to or reliance on credit ratings. Now, at present, Regulation M, an anti-manipulation measure enacted by the SEC in 1997, contains references to credit ratings. Specifically, non-convertible debt, non-convertible preferred, and asset-backed securities that are rated investment grade by a rating agency are currently exempted from the general prohibitions found in Rules 101 and 102 of Regulation M. Reg M prohibits issuers, selling security holders, underwriters, brokers, and dealers from bidding for or purchasing covered security for a certain period of time unless there is an applicable exception. The aim is to prevent activities that may have a manipulative effect on the market for the offered security. So, what did the SEC do? Under the amendments, the existing investment-grade exceptions in Rules 101 and 102 will be removed and replaced by new exceptions that use alternative standards of creditworthiness depending on the type of security in the distribution. So first, for non-convertible debt securities and preferred securities, the new standard is based on the issuer's probability of default. To be accepted, the issuer's probability of default, estimated as of the 6th business day before pricing and over 12 months thereafter, should be 0.055% or less, so 5.5 basis points or less. That estimate must be derived from a structural credit risk model, which the SEC defines as any commercially or publicly available model that calculates, based on an issuer's balance sheet, the probability that the issuer's value may fall below the threshold at which it would fail to make scheduled debt payments at or by the expiration of a defined period. The lead manager of a distribution or a person acting in a similar capacity must make and document in writing that probability of default determination. So that's the new first exception for convertible securities, for non-convertible securities. Now, for asset-backed securities or ABS, the existing exception for investment-grade ABS will be replaced by a new exception for asset-backed securities that are offered under an effective shelf registration statement and form SF3. According to the SEC, the transaction requirements of Form SF3 allow for shelf offerings of only those asset-backed securities that share the same qualities as investment-grade ABS. For instance, investors in registered ABS deals focus on the class structure of securities and nature of assets pooled to serve as collateral. Form SF3 eligibility is also limited by the percentage of delinquent assets. The focus is on the collateral's ability to generate cash flow. Because of the pool's asset quality, registered ABS securities should trade based on yield and creditworthiness, similar to existing investment-grade ABS. So that's the new exception for ABS securities. The final rules also amend Rule 17A4B of the Securities Exchange Act, which is the SEC's broker-dealer record retention rule. Broker-dealers are required to keep written records of the probability of default determination relied upon by them in the distribution. They must retain a written record of the estimate for a period of at least 3 years, with the first 2 years in an easily accessible place. If a broker-dealer was the lead manager in a distribution, it could satisfy the rule by retaining the written determination it had made. If the broker-dealer was not the lead manager, it could obtain from the lead manager a copy of the written probability of default estimate. The final rules go into effect 60 days after publication in the Federal Register. Broker-dealers, in particular lead managers that have been relying on the investment grade exception for non-convertible securities, should examine the final rules. For example, in the context of debt reofferings, lead managers will need to adopt new procedures and incur additional costs to enable them to make and document the probability of default estimate, use a structural credit risk model, and preserve those written records. To learn more, please visit our Free Writings and Perspectives blog. Thank you.